Hey everybody, this is Jim at SP500chart.com. It's about 3 o'clock on Sunday afternoon, July 7th, 2013. We're going to take a look at what took place on Friday, the 5th of July in the S&P, and we're also going to kind of take a look back at the shortened week, only 3.5 days of trading due to the July 4th holiday and the short session on the 3rd. Before we get going, I need to remind you that the website and the video are for educational purposes only, and nothing stated at the site or in the video is intended to be used as investment advice. I can draw lines on charts, but you have to draw your own conclusions from your own research and make investment decisions that are suitable for your personal financial situation. I'm not a licensed financial professional. I'm just a guy who draws lines on charts. And the first thing I want to say is, remember, technical analysis isn't a crystal ball. Sometimes what it really is more than anything else is just our ability to discover things in the chart that tell us that there are important areas. So at any given point in time, we may be looking at a chart with two things in mind. You may be looking at a chart as we were when we were under this green line, but above this green line, we were trying to pick up on some of these little channels and things that were happening on the 5-minute chart. But honestly, what we really were concentrating on, what it would mean if the S&P were to break over the top of this green line, or what it would mean if the S&P broke down through this bottom line. A lot of times while you're in these areas, there's no real way to say, well, it's going up, or well, it's going down. What you can say is, if you break this line to the upside, then we're looking for a move to top or get very close to 1700. Or if we break this to the bottom side, then we're looking for 1572. And so in other words, it isn't so much prophetic as it is diagnostic, with a little bit of projection included in that diagnosis. In other words, when we were trading around here in the 1st of June, I don't think anybody could have said, look for a move to under 1570. Well, you could say it, but you wouldn't have any justification for it, other than that's what your personal feeling is. You couldn't look at the chart at that point and say this is what's going to happen. Or if 1620 gives way, this is what's going to happen. Well, I take it back. That's exactly what you could say once we got further into June. But the point I'm trying to make is that there are times when you look at the chart and the only thing you can do is say, we've got two things we're looking at. If A happens, then look for B. Or if C happens, look for D. Okay? Now, we came into Friday's trading with a couple things in mind. One thing is that we had been considering the possibility of this area right here being an inverted head and shoulders pattern with a target of about 1645. But the interesting thing is that this would be the neckline of the pattern, but the S&P had just been dancing all over this neckline. Now, I showed you a chart, I believe it was on Friday, or maybe it was on Wednesday, after the close Wednesday, where there are times when you have an inverted head and shoulders pattern with an upsloping neckline where that can happen. We looked at the chart of Las Vegas Sands. Had a clearly formed inverted head and shoulders, but the neckline was sloping way up. And Las Vegas Sands has gone from a low of about $1.50 to the 60s, and it's still well underneath that neckline. that it had, but it was sloping up at just a ridiculous angle. So at that point, you look at the pattern and you say that's a bullish pattern, but let's be realistic. It's not going to double every 4 months, you know? So looking at now the S&P, we drawn a couple lines on the chart late in the week. One was this resistance line right here that goes back to the last high. It was in place around the middle of June. Take a look at that right there. Then that happened to line up with these two highs in late July on consecutive days. And the deal, my feeling is that may be a technically important line, and if the S&P can get steam and get over that, then maybe that's the good sign that this will act as an inverted head and shoulders, and we reach that 1645 target. Now I'm going to alter that just a little bit, because as we back off from this chart, we see we got another top way back here, which is the all-time S&P high. Let's move this line back to there. Let's snap it over this top in mid-June and drop it right there. Let's also make it a different color just to make it stand out. Stand out. There we go. Got another resistance line right here that's going to have to be overcome, obviously, if 1645 is going to happen. But I will say this. If it does happen and we get 1645, I think that's fairly bullish, because this line should be turned into support while this line continues to serve as resistance. So it's an interesting chart. And because this line is going up at a fairly steep pace, and this line is descending at a fairly decent rate as well, if both of these things were to be true, and we never get back over this green line, and if we get over this orange line, and we never get back underneath it, all I'm saying is, I'm not saying that's going to happen, but I'm saying that as you project into the future, that gives the markets lots of room to move around. So this could be an interesting situation. I mentioned that that we were looking at the potential of a head and shoulders top, and if the S&P fails to get over this orange line and we get turned back down, and we were to hypothetically take out this purple line, then that would be a very bad sign for the markets. That would tell me that that we're going to be not only losing approximately 140 points in the S&P from wherever this neckline could potentially get taken out, but it also tells me we're probably going to plow through some important support lines along the way. Okay? But that is a very bearish outlook on something that is yet to fully form. But we still, as chart readers, need to have that in mind, and we need to keep this line on the chart. Because thankfully, this neckline is only about 60 points underneath us right now, which means about 4% underneath us, and it is rising. So that's certainly worth keeping an eye on. Now, conversely, if we have a bullish outcome and we get over this orange line, and let's say we come up to this green line, and then we come back down for a back test of this line, well, all of a sudden now we're looking at a chart that's another Rorschach test to determine whether you're a bull or you're a bear. Because the bear would see that big head and shoulders top, but the bull might be seeing an inverted head and shoulders consolidation. This would be the left shoulder, head, and again, pretending for a while that we do get over this line and we get up to this green line here, then another dip down, take out the neckline that would be somewhere, probably about around 1650, 1655. Don't know the slope of it. We don't even know for sure if it's going to happen. So what I'm saying is we have two things. We have a potential left shoulder, head, and right shoulder under development, or we have a potential left shoulder, head breakout, right shoulder not under development yet, for a move to top 1700. So all of this makes you go, why bother? Well, because one of those things, either of those things is a possibility, and they're possibilities that we should be aware of. For right now, I would do this. I would keep this little line down here as a line that if it breaks, then we are likely going to be seeing a trip down to test this neckline, or at least to come down and give 1580, 1570 a run for the money. The reason I say that is because we have been bouncing around for a while between this line and this line. So if this were to break down, you would expect to see about the height of this pattern in a downward move, taking us down to about 1580. But if we get over this, then again, I would take that as a bullish sign that that would mean we probably will stay over this line, just due to the fact that resistance, once broken, tends to turn into support. Now, as the week went, we came into the week with the idea that we may be looking at an inverted head and shoulders bottom. That was the one I showed you here that was outlined in that oval. Well, let's just look at it again. And that the notion was that we should stay over this neckline. Looked like a superly smart call on Monday when we came down to it, when we got clearly over it and then came down and stopped and started to bounce. But on Tuesday, the call didn't look that smart. On Wednesday, the call looked stupid. Then finally on Friday, the call looked smart again. So really, frankly, the week was something of a wash, which, if you look at the chart, it was something of a wash, because we started the week at about we started the week actually with a break upwards to about 1625, and we end the week up a pretty marginal 5 points, 7 points, something like that. 0.5% gain on the week. So coming into this week, let's see what happens with relationship to this orange line. Let's keep both of these longer term scenarios in mind, and reminding you again what they are: the potential for a head and shoulders top forming, which would be a big thing, or the potential for an inverted head and shoulders consolidation, which would take us on up to a new high. Either one of these can happen, and right now we're just not in a position to say which it's going to be. So if we get over this orange line, then things start to look pretty good for the bullish scenario. If we get up to this line, then get turned back and end up taking out 1610 at some point during the week, then things start to look a little bit more favorable for the bearish scenario. So we're looking at two things now, neither of which we know are going to happen, but either of which certainly could. So guys, just hang with it. Let's keep an eye on it as we go through the week. Thank you for your time and attention. Thank you for your support. I wish you well this week, and thanks again.